After tripling in price in 2020, GameStop stock is already up 3.5 times in 2021. And we're not even 4 weeks into the new year. On Friday, the stock climbed as high as 69% before settling in at an eye-watering 51% gain for the day. Now, within a month, we've seen the stock price rise from $20 to $65. If you had put $1,000 into GameStop stock at the beginning of the year, it would now be worth $3,500. So what the hell is going on with GameStop? Hey everyone, welcome back to the channel. My name is CJ and I'm an investor based in Chicago. And today in this stock talk, we're going to try to make some sense of GameStop. Are we seeing a once in a generation investment opportunity? Or are we seeing a speculative bonanza where we should tread with caution? I'll try to answer what the investment thesis is, why the stock is soaring so rapidly, and where that leaves us as investors. I want to preface this discussion with the fact that this is not investment advice, it's for educational purposes only. Oh, and please like the video and subscribe to the channel if you want to see more deep dives like this in the future. Okay, let's dig into it. Okay, let me give a brief overview of GameStop's business for those of you who aren't familiar. GameStop is a leading video game retailer, well known for their used game buyback program. The company is currently in the process of closing underperforming stores and trying to boost their e-commerce footprint. It's generally accepted that brick and mortar retail is on the decline in favor of e-commerce, so it makes sense that GameStop is the most shorted stock on the market. But does it also make sense that GameStop's stock price is rising at probably the fastest rate in the market right now? Even though I've been a lifelong gamer and a customer of GameStop's in the past, GameStop never crossed my radar as an investment until it was announced in late 2019 that Michael Burry, who some of you may recognize from the movie Big Short, who was portrayed by Christian Bale, bought 3% of GameStop's shares outstanding. What really caught my attention about this was that it equaled 10% of his total assets under management. So that's what I would call a pretty high conviction bet. His basic thesis was that GameStop actually had a healthy balance sheet and was well positioned at the trough of a video game console cycle. He thought that the fear of digital downloads and the competition coming from new entrants like Google Stadia were overblown, and it was causing undeserved downward pressure on the stock price. He guessed correctly that the new generation of Xbox and PlayStation consoles would still have optical disc drives, which would be used to read physical discs. He said that these drives would extend GameStop's lifespan considerably. The digital downloads narrative dovetailed perfectly with the end of a console cycle generation, and that created the perfect storm for things looking way worse than they actually were. I thought to myself, fine, the stock is down 72%, and if Burry has reason to believe that cash flows in the future will be significantly higher than they are now, I can see the investment case, but there's still a lot of concern about the obvious decline of brick and mortar retail and the competition from other online retailing giants such as Walmart and Amazon. Much to my dismay, I thought about it and quickly moved on to other opportunities. Now it remains to be seen whether I was wrong in that or not, but the current stock price reflects that I might be wrong. But what's gotten into the stock lately? Early last week, it was announced that Ryan Cohen, a co-founder of the online pet retailer Chewy, was joining the board of directors of GameStop. By the end of the week, the share prices of GameStop had doubled. This was in light of the fact that GameStop's year-over-year holiday sales were down 3%, despite a new console launch. So on one hand, we have Ryan Cohen joining the board, a proven online commerce expert. But there's also another side of this narrative, and that is the short squeeze. Enter the subreddit WallStreetBets. It's a community where high-risk speculators have a penchant for YOLOing their entire portfolio on one stock, or claiming that a new stock is going to skyrocket to the moon. WallStreetBets had been generating so much hype around GameStop stock that it helped create what we call a short squeeze. As I mentioned before, GameStop stock is the #1 most shorted stock on the market. Shorting a stock means that an investor thinks the stock price will go down. So this investor will borrow shares from another investor and sell these shares with the intention to buy back the shares once the price eventually falls and return those shares to the original owner that he borrowed from. The short seller pockets the difference. The problem with short selling is that the maximum upside is capped at a double, because a stock cannot go below a $0 price. But the maximum downside is theoretically infinite. So shorting stocks is really dangerous, and I would not recommend you engage in it unless you are very serious and really know what you're doing. I've never shorted a stock, and I'll probably go to my grave without ever having shorted a stock. So let's return to the short squeeze. A short squeeze is when the stock price continues to rise, and some short sellers will actually buy back the stock at a higher price so that they can return it to the original investor at a loss. This in turn will make the stock price continue to rise, and it will burn any other people with short positions in the stock who will then buy back more stock at a higher price to cover their own shorts. So we're seeing short sellers scrambling to buy back stock, even if it means a loss for them, just so they can cover their short bets. WallStreetBets basically has a vendetta against a famous short seller in Citron Research who claims that the stock price is going to tumble down to $20 per share. So here we're seeing a clash between individual retail investors fighting against these large short investors, and it remains to be seen what's going to happen next. So where does this leave us as investors? I typically try to avoid investing in anything that gives me trouble sleeping at night, even if there's the chance that I can make a lot of money from it. There are just too many unknowns. Is GameStop actually worth $4.5 billion? Is it worth more or less? Is there going to be SEC involvement? Is the short squeeze over, or is it just getting started? Who will be the last fool holding the bag when this short squeeze saga is over? I can't say for sure, but I know I don't want it to be me. For me right now, this looks like a speculative situation, and I wouldn't put any money into it unless I were willing to lose every single penny. It's basically a gamble. Whether you think this is an example of irrational exuberance or a useful mechanism of capital markets, it's really hard to tell where GameStop will end up when all this is said and done. I'll probably end up enjoying the show from the sidelines and trying to learn a thing or two about human behavior and how this new role of social media will impact our markets. If you enjoyed this deep dive into GameStop's current situation, you might enjoy this video over here about the difference between investing and speculation. I also have another video over here about retiring early if you did end up making it big on GameStop. Don't forget to like this video and subscribe to the channel if you found this useful. Thank you for watching this all the way to the end, and I'll see you next time.